You ever wonder why some traders slowly grind their way up, while others flip accounts in days, or blow them up just as fast? The difference usually comes down to whether they're trading spot or futures, and more importantly, how they use leverage. By the end of this video, you'll know the exact differences, the risk, and which style makes sense for you. Welcome back. Today we're breaking down spot trading versus futures trading, and how leverage can change your entire trading journey. Whether you're into crypto, stocks, or commodities, this is the foundation you need before risking your money. Let's start with spot trading. This is the most straightforward form of trading. You buy or sell the actual asset at the current market price. If Bitcoin is $60,000 and you buy one Bitcoin, you now own that Bitcoin. If it goes up to $66,000, you made $6,000. If it drops to $54,000, you lost $6,000. Simple math. There are two important things to know about spot trading. First, ownership. You actually hold the asset. In crypto, that means you can withdraw it to your wallet. In stocks, you own the shares of that company. Second, no liquidation risk. The price can rise or fall, but no one is going to force close your position. The downside is that you need more capital to make big returns. If you put in $100, a 5% move only nets you $5. Safe, but slow. Now let's compare that to futures. Futures trading is very different. Instead of buying the asset itself, you're trading a contract that follows its price. This gives you two key advantages. First, you can go long if you think the price will rise. Second, you can go short if you think the price will fall. That flexibility is powerful because unlike spot, you can profit in both bull and bear markets. But futures also unlock something spot doesn't: leverage. Leverage lets you control a larger position with less money. With 10 times leverage, $100 controls $1,000 worth of Bitcoin. If the price moves up 1%, you don't make $1 like in spot, you make $10. That's the power of leverage. But if the price moves down 1%, your $100 is gone. That's liquidation. Think of leverage like a power tool. In skilled hands, it's efficient. In reckless hands, it's destructive. Many traders get hypnotized by the upside. They think, I can turn $100 into $1,000 in profit. What they forget is that the exact same math works in reverse. And that's why most beginners blow up before they can learn risk management. Let's compare two traders side by side. Trader A buys $1,000 worth of Ethereum on spot. If Ethereum goes up 5%, they make $50. Trader B uses $100 with 10 times leverage to open a $1,000 futures position. If Ethereum goes up 5%, Trader B makes the same $50, but they only put $100 of their own capital. Now here's the difference. If Ethereum drops 5%, Trader A is down $50, but they still hold their Ethereum. Trader B, on the other hand, is completely wiped out. Their $100 is gone. That's the risk of leverage. So let's recap the key differences. Spot trading is safer and slower. You own the asset, and there's no risk of liquidation. Futures trading is faster and more flexible. You can profit in both directions, but with leverage, the risk of losing your capital is much higher. Another way to think about it is this: spot trading is like owning a car and driving it carefully. Futures trading with leverage is like racing a sports car. You can get to your own destination much faster, but one mistake can wreck the whole vehicle. So which one should you use? If you're new, start with spot. Learn how markets move, practice managing risk, and build your confidence. Once you have discipline and a system, then futures can become a powerful tool. At the end of the day, the market doesn't care if you're trading spot or futures. What matters is whether you manage risk and trade with a plan. If this breakdown helped, make sure to hit like, drop a comment whether you prefer spot or futures, and subscribe for more clear, practical trading education.